Even though the US has hit multiple all-time highs this year and may hit another one by the time you watch this video, we are not #1 in the world, at least as far as the stock market is concerned. Hong Kong, Germany, and London have done better, and they're not the only ones. So why is that the case? And more importantly, what are the best markets outside of the US, and how can you get a piece of the action? What are the best ETFs that allow you to invest internationally? Let's go ahead and break it down. Now, there are a lot of reasons as to why. Primarily, the US is going through some stuff. Okay, you've got tariffs that are on and off and currently in the courts. We don't know exactly how that is going to play out. And not just the tariffs, but how are we going to deal with interest rates? How are we going to deal with our debt? How are we going to deal with our data in terms of the Bureau of Labor Statistics? Just a lot going on here, all right? So money is flowing elsewhere. I did a whole short form video. You can check that out here on why that is important. But again, the money is elsewhere. So here are the top ETFs internationally that you might want to consider. And boy, you definitely want to consider the last one here on the list as well. First one on the list is the Schwab International Small Cap ETF. I'll talk about the pros and cons here too. The stock symbol here is SCHC. SCHC, up 24% at the time I'm doing this video, up 22% in the last 6 months, up 24% over the last year. Now, a small cap ETF means smaller companies. If McDonald's is the largest, burger chain out there, then let's say something like Five Guys is something that's relatively small. That's just an example, a metaphor, if you will. And also, it's international. So small cap is known as something that's higher risk, higher reward. Okay, so just to give you an idea. Also, to give you an idea for context, the U.S. stock market, the S&P 500, is up 12% in the last 6 months, 20% over the last year. So for context, again, 22% versus 12 in the last 6 months, and 20% over the last year for the U.S. versus 24% for small cap international. Now, this fund, if I'm not mistaken, it's international, so not in the U.S., but also focuses more heavily in Canada and in South Korea, okay, just to give you an idea. But feel free to look up that fund and drill down and see exactly all the countries that it does invest in. But small cap, again, higher risk, okay, perhaps a higher reward, but that is the first one here on the list. Now, next here, we are going to get region specific in Asia. The iShares Asia 50 ETF. Now, the ticker symbol here is AIA. And the performance here is up 15% in the last 6 months, up 37% in the last year. Now, the benefit of having this fund is the region, or is it more so a concentrated region, which if you are someone who is an expert in keeping an eye on the region and you know a lot about it, then that can help you. It is easier, in my view, it's easier to say I'm an expert in this region and know the set of countries that make up the region, or Asia in this case, of this particular fund, okay, versus I need to know Canada, I need to know South Korea, I need to know Germany, I need to know all these different countries. That can be difficult, okay, it can be more difficult rather to do. For example, Taiwan Semiconductor is in this fund. Okay, that's a company that most of us may know if you're somebody tracking the chips manufacturer business. Okay, so that is one of the companies and the type of companies that are in this type of fund. But the downside is it's only 50 companies. Now, that is more diversified than your average person in most cases, but only 50 companies compared to something like the S&P 500 or something like the Vanguard Total Index Fund, right? It's mostly every company in the U.S., or something like an ex-US fund, which is almost all international companies, right? So it isn't as diversified, but it is region specific, and it's very, very concentrated. So pros and cons there, but again, up 37% over last year is quite a bit better than where the US is. But if I'm looking at just the last 6 months, then not as much. So take a look, see if you like it, but definitely some pros and cons there. Now, these next two are going to take it up to the next level. And if you want to take it up to the next level, you might as well go on and hit that subscribe button. It's totally free. All right. I've given you enough time to go ahead and do that. The next one here is the First Trust Dow International Fund. Now, the ticker symbol here is FDNI. not FDNY, New York, right? It's FDNI. Now, this is the 40 largest and most active. This is what they have on their website. 40 largest and most active international stocks. This has companies like Shopify, Alibaba, so one in China, one in Canada. A lot of us may forget, at least I forget, sometimes the Shopify is a Canadian company. It is up 10%, so just 10% in the last 6 months, but up 53%. Up 53% in the last 6 months. Let me remind you one more time. The U.S. stock market is only up 20% in the last year. This was up 53%. So there is, I would argue, a very good advantage for strongly considering international funds as some part or some portion of your portfolio. Now, depending on where you are, what your goals are, some people say between 15 to 20% of your portfolio, you want to have some sort of international fund. So take a look at what you have now and see, what piece of the pie you want to have there. But this could be one of those, all right? But downside here is it is only just 40 companies here. I would argue that perhaps you want something a bit broader, right? But again, definitely good and solid performance here. And this is where things get interesting. Okay, so this is the most surprising one here on the list. Shout out to boy Bruce, a comment on TikTok. Yes, I'm on TikTok. Follow you boy on TikTok. I finally figured things out over there on the platform, and I'm trying to get to my first 1,000 subscribers. There'll be a link or something somewhere on the screen. In either case, there is a very good reason for investing in Greece. Yes, Greece. Once he said that, I got curious, dug into it, because I was thinking about Greece for a different topic when we were talking about the Bureau of Labor Statistics. In either case, this fund, the SMCI Greece ETF, the ticker symbol is GREK, and it is a 40% in the last 6 months and a 52% over the last year. Why? Why in the world is Greece just one country? Because so that's the downside. Okay, it is just one country. But again, as you kind of see here, higher risk, higher reward. Okay, so you go from, the European, I'm sorry, not the European, the International Small Cap Fund, and you got tons of countries, tons of companies, right? You're only getting a 20% return in the past. So you go from a small cap fund that has multiple countries, right, and you're getting a smaller return, around 20%. Then you get more condensed and you're looking at Asia, right, in that fund, you're getting around 37%, right, and these are previous returns. And then you go to just one country, and now you're seeing 50%. So what is happening with Greece specifically? That's where things get really crazy. And I'm going to do a high-level overview. Essentially, right before the Great Depression, right before the Great Recession, around 2009-ish, there was something called the Greek debt crisis. And what they did was they messed up the numbers, very similar to what we may be doing in the U.S., which I hope we don't end up doing. But essentially, they had messed up their numbers. They had some weird stuff going on around the things they were underreporting in terms of employment, inflation, all that type of stuff. And they were getting loans. Their loans were pretty bad. Their interest rates shot up, and everything just fell apart. And they weren't able to pay back their debts in the way that they were supposed to. Everything fell apart. Their economy fell apart. Their unemployment shot up to a quarter, so 25 or 28% unemployment, and it was terrible for a very long time. Well, time's up. Greece is finally getting out of those things, and after almost 20 years, things are finally picking up, and Greece is finally on a rebound. This is that rebound, and now people are finally saying, all right, y'all are back on your feet. This is a time to invest in Greece. This is the result of it years and years later. All right, so it's taken them roughly 20 years to rebound. And it's why when the president fired the person over the Bureau of Labor Statistics, why Greece came up as an example as to why you don't want to do that. But again, Greece has been through it. Okay, they already went through it, and now could be a very good opportunity for you to invest in that fund. However, this is not because it's just one country, right? Because it's just one country, even though it's an ETF, an exchange traded fund, there's different types of assets inside this ETF. I wouldn't say, let me go put 10 or 15% of my money in it. I would be much more conservative, right? But this is exciting for an ETF. So definitely consider that one. You definitely want to add all of these to your watch list, but be careful between which ones you want to pick, because unless you are an international expert here, you want to take your time and see which one makes most sense for you, because it's something that's relatively new to most of us. But the main thing is, go ahead and get your main US index funds if you're already in the US, and add just a little bit of international, right? We call this international exposure, so you can add a little bit more diversification. And if the US is doing well, hitting all-time highs, you can also get just a bit more by investing outside of the US too. So check it out if you want to know more about what's happening outside of the US and how well those markets are doing, and perhaps some other stocks that are doing well too. Check out this video right here.